It's time now for the Gem Young Wealthcast. Brought to you by Gem Young Insurance and Wealth Advisors, a family-owned independent insurance and financial planning agency since 1947. Now, from their studio on Star Center Drive in Canfield, Ohio, here's the host of your program, Leo Daprile.
Welcome to the Gem Young Wealthcast. This is Leo Daprile. Today is part 2 in our quarterly analyst series about what's going on with your money. Not that there's been much to talk about, but we'll find some things to talk about. I have one of my favorites. I have Phil Blancato with me. He's the CEO of Ladenburg Thalmann Asset Management. Phil and I have known each other and worked together, gosh, I'm going to say close to 20 years now, if not more. I probably lost count along the way. So, Phil, welcome back. Thanks for joining me today.
Thanks for having me back, buddy. I'm excited to be here. It's one of my favorite things to do with you.
Yeah, it's finding out that we're both have Sicilian roots, right? Didn't know that.
We do.
And all that
yes,
time.
We must have had this conversation. My father was from Montecamastra, Sicily, which is in the province of Messina. I've been there many times, and I don't love the connotation, but for those who want to know where the reference in the movie The Godfather, where Michael Corleone gets married, much of that scene was filmed where my dad grew up.
Wow. Okay. I just know my grandfather was from Messina. Where exactly, I don't know, but my oldest brother, Jimmy, will know. I'll get into that. So
we're going to have to talk about that offline, but maybe we'll do a whole podcast just on that. That would be fun.
Yeah, that would be fun. Yeah. I'm the baby boy, Phil. You know, as you know, I'm the 11th of 13. So my oldest brother, Jimmy, he's the one that has all the knowledge. I think by the time my parents got to me, they're too worn out to tell me.
I get it. That makes sense.
Yeah. So a lot of interesting things this quarter. The pink elephant in the room is the war or conflict, however it is. And the markets overall have been fairly resilient. And it always goes back to one of the phrases you always say, and one of the things we believe in is it's the data that drives the decision. It's not the headline risks that drive the decisions. The headline risks might make for short-term movements, but the underlying data is what really drives things. Now, we know oil's up. We know that gas is currently around $4 a gallon. That certainly has its economic impact to it. What's your take on that?
Well, I'll give you an easy one to start, and some of the folks on the listening to the podcast, I think, can relate to this. If you think about what we used to get for miles per gallon in our car 30 years ago versus miles per gallon today, obviously it's increased quite a bit, almost by about 25%. We used to get about 15 to 16 miles per gallon, and now we're closing in on 25. So when you look at the average person and how much they spend on the money they make per week and how much they spend on gas, it used to be about 3% of your annual earnings would go to gasoline. Now it's about 1.5%. So while it's not fun to pay more at the pump right now, when you think about the U.S. economy, it's very insulated from what's happening in the Strait of Hormuz. Why? Because I'll give you an easy example. If you think about natural gas in the United States, your home electrical bill. Now, sadly, your home electrical bill is probably up around 15% year over year, but nothing to do with what's happened overseas, but for all the other reasons around data centers and the more demand for electricity and so on, leaving that aside for a second. In our scenario today, we look at the price of natural gas, which is very much correlated to how much you pay for your electrical bill. Natural gas in the United States is actually flat to even down a bit since the war started. We have a ton of natural gas in the United States. We're the number one exporter in the world, the number one oil exporter in the world. But if you look at Germany as a comparison, their natural gas prices are up. Are you ready for this? A whopping 50%. So wow. It really does bring a lot more pain to Europe and Asia than it does to the United States. So my point is, while your gas prices are going to be a bit higher, and I'm sure you don't love spending more at the pump, if you're going to go for those of you who might be celebrating Easter, if you're going to do a 100-mile drive to family this weekend, and sure enough, that drive would maybe cost you $50 a tank full a month ago, that tank full is probably going to cost you somewhere around $65 to $75. Probably about 25% more. So is that going to stop the U.S. consumer from driving? No. That's not what we've seen. Does it make folks angry when they spend a little bit less potentially? But as of now, it's much less about the U.S. economy and much more about Europe and Asia.
That's interesting. So we still had a fairly healthy correction. And one of the things we spoke about, and it was interesting that my four analysts all had a similar prediction for the first 6 months of the year. All of you expected a great deal of volatility in the first quarter. And you're all right, but didn't know the reason why. But the argument,
No.
but the argument in Q1 was everything's sort of priced to perfection. And that bar gets higher and higher to meet. So the war was maybe a catalyst for this price correction that we've gone to. It may have been, but may not be the reason for it, because things were just so, like I said, so close to perfect that we did need some rationality back in the market, right? And I think it's fair to say too, Phil, that some companies, like always, when there's a price correction like this, get punished more than others. Even if it doesn't really have a big effect on their earnings. And guys like you look at that and say, well, this creates buying opportunities, not a crisis, right?
Exactly. That's exactly right. Could have said it better. I'll give you an easy example. In case of folks like me take advantage of markets like this. If you think of last year when we talked about the first quarter, we thought there were many other areas of the market that were going to be a heck of a lot better off place to be than in those big mega tech names. So just if I had to quiz all the folks listening to this podcast, I'm going to bet 99% might get this question wrong. I'd argue we are not in a correction. I'd argue the market is in great shape. And in fact, if you manage your money properly, you're up on the year, not down. Here's why. If you look at the broad-based S&P 500 and you look at all the stocks in it and you just treat them all equally, not weighting them by size, believe it or not, that number is up on the year, not down. The equally weighted S&P is up almost 1%, where the S&P 500 is down 4% as of today. So what's fascinating about that is if you believe in the old adage of don't put all your eggs in one basket and you own some mid-cap stocks or some small-cap stocks or international, you're actually having a heck of a year. You're doing quite well. And this whole event is meaningless. So to the point you made, when the market is priced at the most expensive stocks, the biggest stocks got you here. Which ones take the pain in an environment like this? Those which were the most expensive here. They'll go at the highest price. Those who didn't have a high price and actually have a pretty good year are doing just fine. For example, value stocks are up on the year, not down. So we can have a whole discussion about if you just believe in that you don't take excessive risk by betting on a handful of very expensive stocks, you could do quite well.
I'm glad you brought that up, Phil, because amongst our client portfolios, I think when they open their first quarter statements, whether it's online these days or whatever, I think they're all going to be pleasantly surprised because of the level of diversification that you provide our clients within their portfolios, along with the other managers that think philosophically along your lines. We did fine in the first quarter. It may have been a little bumpy getting there, but that's normal volatility for guys like you and I. So that doesn't even faze us anymore, right? We just know that we just know that's part of the game. We just know that, if there's a strong headline risk, that it's going to be more of a volatile day. And then we always know 2 or 3 days later, once that headline risk sort of simmers down, then the rational trades come back into play where there's more opportunity that was created and starts pushing things back to where they should be in the first place, right?
Exactly. And what's fascinating about this is that, when we've talked about why the market would get volatile in this year, the conflict aside, it was because that the most of the market, almost 50% of the stock market, was dominated by the top 10 names. So it's almost like a grandfather clock, that kind of pendulum that goes back and forth. The pendulum had swung so far to a handful of names, inevitably it had to come back the other way. Why? Because we're a diversified, very powerful, very large economy where 82% of the American workforce is with companies that have less than 250 people in them. So finally, these other companies, because of lower interest rates, a very good, a very strong U.S. economy, lower borrowing costs that have come down, productivity gains, AI making you more efficient. All the other companies are putting up revenue growth, earnings growth, how much money they're making. That's really good. And so you had an opportunity to do well in other places besides those names. But you hit on something very critical, Leo, which is we get lured into a handful of really good ideas. NVIDIA is all everyone talks about. And sadly, you forget about the benefits of all these other markets and where you can go and invest your money And what we see is people pay for that. They get punished for that. What do guys like me do? At times like this, we buy when people are fearful, and because we just take advantage of better prices. Whereas everyone else is going to sell when they never get around to selling. They get so greedy they never sell. So that's where we take advantage of it.
And it shows, and that's discipline. And it's funny, Phil, for years, the diversified portfolio was almost becoming the ugly stepchild, right?
Yeah.
Because the mega cap stocks were so much driving the bus. And in the last 2 years, the rational diversified portfolio, diversified by asset class, diversified by company size, diversified geographically, and then plugging that into client risk tolerance is what's really back to, I'll call it the rational investing standards seem to be back.
Well, Leo, this is a bigger, harder conversation, but it's a very important point you're hitting on. We went through something in our lifetime, starting in really 2001 to a much greater degree in 2008, and certainly at a much greater degree in 2020, where the federal government took the size of our debt and exploded it, attributed basically in the grand total of it all, about $15 trillion. And why that's so really important here is when all that money gets printed, it tends to send markets in a very unusual place. The money had to go somewhere. And you saw it when the price of houses had have tripled, or depending on where you live, or at least doubled. Your stock market up a bunch more. All that money flooded into the economy. So what happened was, rather than being in a diversified portfolio that certain assets would win, certain assets would lose, depending on what's happening in the economy, it meant that all that mattered was the biggest areas of the market, the biggest companies, and the ones who could put the money to work, and the hard assets in the country really benefited. So since 2008, it's been kind of almost a fool's errand by anything but the S&P 500. Why? Because really just a handful of stocks over the last 15 years have driven the market higher. Well, that's suddenly all changed. Why? Because the federal government is no longer printing money. We're no longer in excess stimulus mode. We're no longer giving money out for cash for clunkers all the way to a pandemic recovery. So what's happened is a process of going back to normal. And for the body of our lifetime, in fact, the body of the history of the markets, normal is what we lived in, which was normal interest rates of around 4%, not where they are today. Normal inflation, where they are, normally about 4%, not 3% where it is today. Normal unemployment of 6%, where today it's 4%. My point is, we're slowly working ourselves through this massive amount of printing that happened. And why that's so critical is because if you go back to normal, it means normal stock market returns, normal bond market returns, but a diversified portfolio will protect you when markets are down. That's critical. You want to lose less when markets are down to make more over the long run. And that's why this year is so indicative of the last couple hundred years in markets. Now we're no longer printing. We don't have exuberance in just a handful of areas. It's gone back to normal.
Yeah, and it's like anything. It's so basic, Phil, that you lose sight of it, and the investors lose sight of it because of the greed that when something doubles and then doubles again and doubles again, it gets to the point where you get so large that next double gets almost impossible to do. And that's like a case of an NVIDIA, for instance. How long can that continue to double before it just becomes irrational to do it? A lot of these Mag 7 stocks, a lot were the tech companies, right? Where now there's threats to their business. And up until 9 months ago, nobody saw threats to their business. My new word I've been using, Phil, the last couple of months on the podcast, we lived in a hunky-dory world, right? And we're getting back to it, like you said. I'm glad that was a very, very well-reasoned analysis of the flow of money, because I think a lot of people don't think of that, Phil. So let me jump back there a minute, because to its core, not to oversimplify the economy, but our economy is pretty much a supply and demand driven scenario. And that's not only just goods and services, but it's also the flow of money in and out. So to your point, through all the years when there was this amount of cash, the cash had to go somewhere, right?
Right.
Goes into goods and services. Companies sell more, prices go up, people have cash to buy more stocks. And then when you're reducing that supply of money, now the remaining money is competing for less things, right? There's less money to compete for things. Let me say it that way, right? So so now the people with the money are getting choosier what they do with it, right? So that's why they're looking at more diversified portfolios, looking at different companies, because it's not just, okay, that company's going to keep going up forever and ever, and I need to have something that is earning the right to have my money. Fair enough?
Exactly. Or put it a different way, where do I get the best value for my money? Where am I going to go and get extreme value for my money based on the fact that I don't have an endless supply rate? I'm not being gifted money. And there's a lot of reasons why the housing market has tripled, not just this, but that probably predominantly is this, the stock market. So you're hitting on what really matters to the end investor. How do I not panic when markets are volatile? It's because you own quality investments that are going to lose less when markets are down, which is what's happening this year.
So I don't want to be insensitive to the human consequences of the Iran war or conflict, but this podcast is about money. So I would rather have a conversation of saying, and you brought this up earlier, I just want to come back to it for a minute because I think it's important that most of the economic problems or challenges being caused by this war or conflict are more felt in Asia and in Europe than they are in the United States, right? So if that's the case, what was my argument? Let me tell you my perspective first. I think the whole thing with Venezuela and the whole thing here is to try to wrest more control over the supply and distribution of oil. And I think those are negotiating levers for China to try to balance out their increasing power, because we're losing more economic negotiating power because of their size. Although I think in the long run, I think the decades of China's policies of one-child policies, I know that's a longer-term problem, but I think that's starting to show in their economy, and I think that's going to start. I think that child policy will do more to cripple China long-term than anything we can do to them. But that's right. But that's what I think the regional scenario of with us being into Iran. I know it starts out by saying decimating a nuclear power and a nuclear program, and that might be true. But I had Glenn Dorsey on last week from Clark Capital, and one of his too is, the side benefits, or maybe the benefits of this war not being talked about, is to cripple the drones that Iran is sending to Russia. So that could be multiple strategies of what's going on. Thoughts on that?
Unintended consequences of never letting a crisis go to waste. I'll give you a perfect example. You hit on it. What type of crude does the United States get out of the ground? Sweet crude, the best crude in the world. What kind of refineries do we have in the United States? We can only refine heavy crude. Why? Our refineries were built 50 years ago when we imported all our oil from the Middle East. The oil embargo of the 70s changed that narrative. So now we take this wonderful sweet crude and we send it to Mexico or other places in the world where they can refine it. We haven't built a new refinery in decades. Fun point, what type of oil does Venezuela get out of the ground? Heavy crude. What are our refineries built for? The type of oil that comes from Venezuela. The 3 million barrels a day that come to the United States, what does it do? Supplements U.S. oil supply, brings Venezuela back online. Now, in fairness, it may eventually stop illegal immigration at the border. And if you look at the history of violence against women in Venezuela, it's the worst in the world. The gang culture of Venezuela is so terribly bad. The young girls are indoctrinated and basically kidnapped in the gangs when they're below the age of 13. So there is a humanitarian crisis in Venezuela. There's an economic crisis. But to your point, never let a crisis go to waste, because now we've got a lot more oil on the global market at a time when you're taking 3 million barrels off the global market from Iran, supplementing with 3 million barrels from Venezuela. Cuba, you want to bring Cuba to heel? Cuba, the only place they get oil from today, when they can get it from Russia, leaving that aside, is Venezuela. What does Cuba do to power their island? They use old school generators powered by diesel power. Where's the diesel fuel come from? Venezuela. How do you bring Cuba to heel? Well, you control their energy supply. And then more importantly, the Ukraine-Russian war, where Russia today gets many of their drones from Iran. You've not only cut that supply off, you now cap the ability for Iran to make any money on that. But then beyond that, obviously there's a humanitarian crisis there as well. And to your point about China, which I think is less relevant. I don't know that I would agree on the China piece. Yes, you're right on demographics. If you look at the percentage growth of their GDP, it's been declined for a number of years now. They had a wonderful first quarter. But the size of growth of their country as to where they're supposed to be versus where they are, never going to happen. They're never going to catch the United States. They're never going to grow at the rate they were expected to grow at. And the reality is they're going to go from 1.4 billion people to 660 million by the end of this decade. That's why. But they can get all the oil they need from Russia. And that we haven't been able to stop that supply, and I don't know we'll be able to stop that supply. So I think it's you're all right that it does to cap off the Venezuela issue. It limits to some degree what Iran can send to China, but mostly they get their oil from Russia. I think ultimately I'd look at this scenario and say there are other aspects of this war that make you believe we went in not just for the humanitarian crisis and the terroristic nuclear aspect of it, but certainly the economic impact, I think, is one that is going to be fascinating to watch. And what does it mean for, changing the world order around how economics are done and the United States' position in the world? If this all works out, and we don't know that it's going to, but assuming it does change the world order for maybe Venezuela, Cuba, Iran, and where oil comes from and what the United States' role in it is. Remember, 70% of oil in the world is traded in petrodollars, which are dollars used to trade oil. We still control the money supply, which is very powerful for the U.S. economy.
Let me ask you a follow-up question. I'm thinking as you're answering the question, I think you said, correct me if I'm wrong, 1.4 million Chinese today. The end of when it's going to be 660 million? When's that trend?
End of this decade, by 2100.
By 2100. Okay. So what does that mean in terms of, should we be that worried about China? I mean, from multinational companies' perspective, you have a declining population base, you have a declining buying group, so that threat just seems to just almost dissipate by itself over time, right?
It does. And I'd argue, what's the threat? I've always struggled with the Chinese threat. One, they make a lot of stuff that we buy. Okay, I agree. That's a threat to U.S. economy. In the one big beautiful bill, the aspect of depreciation, which means if you own a company today, you own company A, and you want to build company B, and company B costs you $1 to build it, you can take that $1 and immediately deduct it from the revenue you make of company A. What does it mean? The one big beautiful bill gave every company who wants to invest in the United States a gigantic tax break, because you're not going to pay taxes on any construction that you do. What's it also mean? It means the last 3 months we saw U.S. manufacturing be increasing again, not decreasing, for the first time since 2022, which is a very powerful moment. No one's mentioning it. And maybe you'll go from 12 million jobs in manufacturing to 15 or 20 million. It's a renaissance potential beginning in U.S. manufacturing. So that threat, I worry about that China will continue to offer prices of goods that we can't compete with. And that's where tariffs do come into play. Lithium is a great example. MP Materials was once the biggest lithium producer in the world, a U.S. company, and now it's out of business because China flooded the market with cheap lithium. But I don't see the threat as China outside of manufacturing as a big deal. Will they eventually take Taiwan? Probably. I'm watching Japan recently embolden and fortify the islands near Taiwan that Japan owns. So hopefully it doesn't become a military conflict. But what's the threat of China anymore? I think the threat is, do they want to eclipse the U.S. economy? No, it all comes back to economics. They won't. Will they continue to be the manufacturer? No, because you're watching Vietnam, Malaysia, Bangladesh, and so on be very active in making stuff for us. So I guess I worry less about the threat of China. I'd like to see them buy more American goods, which they never will. So that probably is the outlying threat. To your point, though, from a geopolitical standpoint, if you want to be the gorilla in the room, you want to control the global currency, you want to control the U.S. economy, you want to be the biggest in the world so you can have influence everywhere and stay in pole position, you do want to make sure that China comes to heel on some of the things around cybersecurity, around defense, and most importantly, what happens in the AI space. So there's some reason to be concerned, but I don't know if I'm as concerned as everybody else about the threat of China.
Well, reason as always. Believe it or not, but as always with you, we're out of time. I need to hop off for a break here. We'll be back in a minute. I have Phil Blancato with me. He's the CEO of Ladenburg Thalmann Asset Management. This is Leo Daprile. This is the Gem Young Wealthcast. I'll be back after this break.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
At Gem Young Insurance and Wealth Advisors, we believe your financial goals deserve more than just a plan. They deserve a team. From planning for a work-optional lifestyle to managing risk and supporting your everyday needs. Our financial planners, paraplanners, and service team work together to build a strategy that truly fits your life. Planning for the future will help you make that confident financial decisions and achieve lasting peace of mind. Call Gem Young Insurance and Wealth Advisors today, 330-533-6936, to schedule your fit meeting and start building your financial future.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo Daprile.
Welcome to the Gem Young Wealthcast. This is Leo Daprile. Just joining the podcast today, I have with me Phil Blancato. He's the CEO of Ladenburg Thalmann Asset Management. One of the brighter minds in the business. He's been with me for years doing our quarterly analyst review. Long-term friend of mine and finding out a fellow Sicilian. So, hey, Phil, welcome back.
Thanks, buddy. Happy to be here.
I always do try to stay serious. I just can't seem to do it, Phil.
Well, sono felice di essere qui con te. I'm happy to be here with you, buddy.
Thank you. I wish I could speak like you do, but I don't. So let me shift gears for a minute. We talked about how, at least from a portfolio perspective, no matter the noise in Q1, you guys pretty much insulated all of your clients from that. So I made the comment early on in the show that once people open up their statements, I think a lot of people are going to be pleasantly surprised on how they really did in Q1 despite the negative noise. And one of the things, and I just want to recap a couple of things, and I'm going to shift gears, is one of the things that always amazes me, you brought up a couple of key points about the increase in manufacturing. But a lot of good information is not being disclosed because it's not the gotcha news, which seems to be the cycle that we're in now. And we have if it's not negative, scary news, people, they're not playing it and people aren't listening to it. But there's all this other news, and it's one of the skill sets that you guys have always had is you've always stayed away from the noise and always kept to the data. So we're way better in quarter one. Our clients are on all elements than people think. So let's shift to Q2 for a minute. I know we have a new Fed chair coming in.
Maybe.
Okay, because I want your perspective on that, because one of the things I've been saying, Phil, is with everything going on and the pressure the president's going to put on whoever that person is, and the fact that it's not an autocratic decision, it's a group decision. And I know the noise will be about reducing rates. And quite frankly, having both of those people and the president pushing this way and the other board governors pushing another way, that's a job, Phil, I don't think I'd ever want. I don't think there's any way for the next Fed chair to win and appease both sides of this.
Yes, I think you're right, but there is one caveat here I have to hit on. One, why I say maybe on Kevin Warsh, unless the lawsuit against Jerome Powell's dropped, he's going to have a tough time getting confirmation, the $2.5 billion reconstruction lawsuit. So usually these things get worked out in some sort of partisan politic, handshake agreements. But let's assume that and by the way, Jerome Powell has offered to stay on until the new governor is picked, so that he might be around for a while. I don't actually think Kevin Warsh is going to get the job come May. I think he's going to bail a little bit longer than that. But to your point, which is spot on, How do you cut rates at a time when, I'll give you an example. I'm very excited about how ISM manufacturing just this week, which is on a scale of 1 to 100, and generally the range is 40 to 60. Anything above 50 is expansion, anything below 50 is contraction. So we've been in contraction of manufacturing for years. And suddenly we're back at expansion above 50. And if you look why, productivity is up, demand for U.S. goods is up, but prices are up. And prices are up about around 10% over the last couple of months. Now, prices can change month to month depending on global supply and demand and so on. But you look at cost, the inflation in the interior of where we're at, core goods, you look at something called PCE, personal consumption expenditure. It's the most important gauge that the Fed looks at. And it's 148 data points that are updated every single month. And you look at that number, and the core PCE, taking out food and energy because they're very volatile, it tells you that we're still stuck at about 3% inflation. So the Fed doesn't have to rush to cut because we don't see the trend going further down. Ultimately, we're an aging country to some degree, the wealth of the country with older folks. AI could be very much deflationary with how we control wages and things, but we're not there yet. So ultimately, we might get there, but we're not there today. So to your point, the new governor is going to have to deal with inflation that's stuck at 3. Look at the number. Unemployment market that's a no hire, no fire world. Not terrible, not great, but kind of just plain vanilla. Oh, and by the way, if the oil stays above 120, right now we're between the two, it stays higher for longer, that would eventually be inflationary. So you're not cutting anytime soon. So the next Fed governor, to your point, I wouldn't want the job, except one caveat. Here's the caveat. I don't know that the Fed has nearly as much influence as everyone thinks they do. And here's why. Actually, we talked about earlier. When you print upwards of $14 trillion and a lot of that cash still sloshing around the economy, it's not like the local bank out there is starved to give you a loan. Other than regulations, which have made it hard, there's plenty of cash to lend money back and forth right now. We haven't drained that cash out of the system. So when the Fed lowers and increases interest rates, I'm in the camp. I don't think it has much of an impact. I think there's so much cash. Just the other day, we looked at the stats in local money markets. There's an excess of $7 trillion just sitting there in money markets that are earning 3%. So I don't think the Fed has nearly the impact that everyone thinks they do. And I'm probably alone in this. I'm probably unique in this. I think it's much more about traditional inflationary economics based on supply, demand, and where the price of energy is. And right now, it's all kind of flat. And if oil does spike for a longer period of time, we're not going to get a cut. But I'm not convinced the Fed has that much impact on it anyway.
I would agree because I say all the time, interest rates cut only matter to borrowers. If you already have loans and interest rates, unless it's a high interest rate loan, you don't really care, right? Mm-hmm. And did a quarter point cut really make a decision whether or not you bought a house or bought a car? My answer is no. No. Because when people buy homes, yes, interest rates matter, but the conversation's around the payment, not the interest rate, because the interest rate is what it is, and they live with what they can afford or not afford.
And to your point, interest rates right now are on the 10-year treasury trading at 4.3%, which means mortgages are about 6%. By the way, historical mortgage rates are about 8% in the United States, and between 6 and 8. So the housing market should be great. Instead, it's not. Why? Because there's so many people with very inexpensive loans that they don't want to get out of them. So the market's stuck right now. So whether the Fed raises or cuts or anywhere between is indifferent to all those people who have existing mortgages. You are absolutely right.
So is the main push, President Trump's main push, just to manage the deficit, in your opinion?
I think it is, because as of today, for every $5 we make, could you believe $1 goes to making just the interest payments on our debt? Every $5, $1. It's quite incredible that we have this scenario where we're paying so much in interest payments because the size of our debt. One, we got to find a lot of people to buy it, a lot of countries, a lot of people, a lot of pension funds. And two, we got to pay higher rates of return so that people keep buying it. So I think the president would like to see the costs come down of financing the debt, which makes the deficit easier to manage. But ultimately, I think you have a really tough scenario on your hand, which is we're not getting out of this debt anytime soon. We are unable to fix Social Security. You need to raise the age of when people get it. You need to make it so people have high income over their life probably never get it. Maybe make people contribute a little bit more than the current caps. We've got to fix Social Security. And no one has the will to do that. And then beyond that, if you had lower interest rates, it would bring down your cost of borrowing somewhat. I just don't think he's going to get his way anytime soon.
So one conversation we had in January, and it was a good conversation we had, where the debate was around, why do we have to get to a 2% inflation rate? What's wrong with 3? That was the premise of a discussion we had back in January. And we both were in agreement that that'd be okay. As long as wage inflation was there and above, does the 2 matter? Do you think the next Fed chair is going to redirect that? Because it almost seems like the Fed trying to get to 2%. Right now, companies are growing. Wage inflation is keeping up with inflation.
Yep.
The economy's strong. It looks like the trends for earnings coming into Q2 are strong. To really push back to a 2%, from my world, it's almost starting to sound punitive.
I think you're right, because I don't think we're ever going to get there. We have just too much debt. We got to keep our interest rates high enough so people buy it. The one thing Kevin Warsh has said, which I find fascinating, is he might make the Fed have 3 mandates instead of 2. Today it's keep full employment and keep inflation low. The new mandate might be to drain the amount of money in the money supply, the amount of money at the Federal Reserve. The Federal Reserve has excess of $7 trillion just sitting there today. He didn't say any reason why it should be there. So the quicker they give that money back to the U.S. Treasury, you're taking money out of the supply. Usually what that means is less money available, less lending, lower inflation, and at that lower interest rates. I think he's going to have a tough time getting there. That would be interesting if he went to a third new mandate or a third new requirement of the Fed. Probably not going to happen anytime soon. I think you have a scenario where, to your point, we're stuck in this range for a long time, except the overarching theme is that ultimately demographics today, basically, when you look at U.S. assets, 70% of American assets are with people over the age of 65. So that is critical because they have different spending habits than those who are 25. So as that group ages older and they spend less, that'll bring down inflation. And then beyond that, technology. Now, we all know that AI, this industrial revolution we're in, depending on whether you're using it or not, it has an impact. I would bet you anybody who's actively using it has found efficiencies in it. And it does make you more efficient, whether you're trying to find an answer to something or you want to make your business more efficient. There are efficiencies that should come from it, which ultimately would bring down the cost of inflation. I'll give you my favorite example. I might have mentioned this last time, Flippy the Fryer. Flippy the Fryer is a robotic arm that's in fast food restaurants, specifically White Castle. Last year, Flippy the Fryer fried, believe it or not, 5 million baskets of French fries, and over 200,000 man hours were done by that machine. Why that's important? There were no benefits paid, no wages paid. The fryers showed up to work every day, fried a perfect French fry, and reduced the cost of that operation significantly. That's deflation in real terms. That's because of AI. Ultimately, we get there, just not as quickly as I think Kevin Warsh, the president, would like.
Okay. I think you consider me a reasonably smart guy, but I want to ask. I want to ask you, and I'll call it a painfully simple question, because I'm sure a lot of people look at the world this way. If we have $14 trillion in debt, and if we have a Federal Reserve who prints the money, why can't they just take that $7 trillion on their balance sheet and throw it in the trash can and reduce the debt by $7 trillion?
Good question. So yeah, the total amount of debt is $41 trillion today.
Oh,
That's the gross debt.
Okay, or take $7 million off that, right?
Right. When I look at our debt to GDP ratio, I look at the net debt, which is roughly $34 trillion. We make about $31 trillion. So today we owe more than what we make. So to your point, I think the most economists, most money managers look at the net debt as a scenario, because really you don't need to do it, except here's what happens. Right now, the U.S. Treasury pays the Federal Reserve interest payments. When the Federal Reserve gets those interest payments, they can either buy more bonds in the marketplace to increase or decrease interest rates, create supply and demand, or give the money back to the Treasury. That mechanism is no longer necessary. It was necessary during 2008 to keep markets working, make sure there was always a buyer or a seller. That's no longer necessary. So I would think that those mechanics should go away. If you do that, then there's less cash in the system, because the Federal Reserve could either put that money, give that money to a local bank or back to the Treasury. So there'd be less cash in the system, which would then bring lending down a little bit in theory, but also bring down inflation a little bit. So your real number is, when you hear that gigantic number, 41 trillion, don't look at that number. The real number is 34 trillion, on its way to 35, because we can't seem to get our annual budget deficit to be lower than the average income. Our annual budget deficit is always higher than how much we make per year, right? And this year is probably going to be about 1.5 trillion. And that's our biggest problem. So long answer to your question is, it's sort of not, it's not very relevant to the grand scheme of the debt. It's relevant to getting rid of that 7 trillion, would bring down the money supply, bring down the number of dollars in circulation, which brings down inflation, and maybe a bit of growth. So that's why they're being very careful not to do it.
Is that why they stopped it? Because it was 11. Wasn't it 11 or 12 trillion at one time?
It was almost 9, and they started to unwind it, and then we saw certain markets freeze up a bit because the Fed wasn't in there buying bonds and paper, and it kind of made it a little bit goofy that they got concerned, and then there was this little mild spike in inflation, so they stopped doing it. They felt that they were putting too much pressure on the market. I think worst opinion is we could solve some other masters by getting rid of it, kind of in line where you're at. And whether or not he's going to be able to do that, it takes all the governors to agree. And as of right now, I'm not sure all the governors are going to agree with what he wants.
So I want to ask you this before we have about 5 minutes late. This is a bigger question, because this is at least what crosses my desk is the ability to take clients' money, and this is my CCO hat on, Chief Compliance. I'm not endorsing, recommending, anything like that. This is just a conversation topic that seems to be becoming more frequent in my practice, and that's use of private credit and private equity. From where I sit, for most of my clients, and I know there's pros and cons to where it can be used, but from where I sit, I've not been compelled or convinced that these two types of asset classes should necessarily be massively added to my clients' portfolios. I'm just not there with that. I think there's relevance for some, but not all. I worry, especially now in Q1, there's been a lot of noise around the struggles with some companies with redemptions in private credit, and I think it's giving that industry a black eye. But my challenge is, and what I say that part of our job is, we need the publicly traded companies, because most of our client portfolios, most of our clients are dynamic, Phil, as you know, and so their portfolios should be dynamic as well. But this is a hot conversation. So what's your take on it?
Well, to get on my soapbox for a minute, you said something on the second half of your question that's important to me. The number of publicly traded stocks continues to go down every year. Why? Because of overregulation. It's just too expensive to be a publicly traded firm. Multiple audits in a year, the cost of being publicly traded, the cost of filing each quarter for your earnings reports. So my hope is that for the average investor out there, there's a chance for the world to come to sanity, and actually, not just the United States, the world, and make it easier to be a publicly traded firm. Europe, for example, is in much worse shape than us. The number of stocks on the London Stock Exchange is soon going to be below 1,000. I know we're going to get big SpaceX announcements here, and a couple of big names that are going to come to market. But by and large, we just don't have enough publicly traded firms because of the cost of doing it. So when you think about the market today, why did private credit and private equity explode over the last 15 years? Well, never let a good idea get in the way of regulation, or should I say never let regulation get in the way of a good idea. Remember 2008, Dodd-Frank? Out of the Dodd-Frank regulation came draconian measures to reel in risk that banks take, which was a terribly bad idea. Banks need to take risks. Your local regional bank who invests in Mr. or Mrs. X who wants to start a new company is a critical component of the core of American capitalism. So when you took that away or made it much harder to do, where'd the money go? To the private world, not regulated by the federal government. So now you got 15 trillion or more in private credit world. And what's the problem with private credit? There's no transparency. You don't know what's happening. In the public world, you know everything. In the private world, you don't. So a lot of folks ran there because of wonderful yields on the portfolios, and they thought it was a way to supplement their returns. Well, now, somehow the media has gotten a hold of this, and they took what I think was the wrong story and made it much bigger than what it is. So now we're seeing a massive run on firms like Blue Owl, to a lesser degree, Blackstone and BlackRock and Apollo are having to make explanation as to what they own, explain their default cycles. By the way, defaults so far really aren't very bad. Yet there's a significant amount of people trying to exit private credit. Why? Because of a lack of transparency. So they want to get their money out if they can. They're thinking it's worse than what it is. Oddly enough, we're not seeing any companies default. We're not seeing any companies go bankrupt. Yet there's this worry that there's much worse things there than what we realize. And it's all a byproduct of 2008. But I would say to finally answer your question, which I'm taking way too long to get there, forgive me. I don't love the idea of being in a 401k. I don't love the idea of someone taking their long-term retirement plan and putting it in a private space that we don't know what it's invested in. For those who are wealthy, have extra cash, don't mind having an illiquid aspect to their holdings, who want outsized returns in either equities or credit, bonds or stocks, if you will, in private companies, it's not a terrible idea. I like interval funds, which have some liquidity to them. But by and large, it's something you really need to understand. You need to get the information right before you make that kind of investment. And I don't love the retirement plans.
And Phil, that's exactly where I'm coming from. And the parallel that I drew was 25 years ago to the non-traded real estate investment trusts, right? Mm-hmm. And my complaint was, why would you buy those when you could buy publicly traded real estate investment trusts where you had transparency? Not that they're bad, but to your points about transparency, when people don't know, people panic. And they're going to make the irrational decisions, because when they ask you a question that you can't answer, then that also becomes a credibility issue for me. You know, if something's happening, like you said, to some of those companies. And I had the opportunity to have a meeting with one of the directors of one of those companies that you mentioned, and he was just furious because they're a well-respected, well-run company, about how that industry kind of went a little rogue because as more money came in, it got a lot more competitive. So they were being a lot less stringent on the types of loans they were making just to compete for the loans. And he said there was a few companies that were creating trouble for the entire industry. So, all right, Phil, I'm really out of time, but I got to ask you one more quick question if I can. Where do you see the rest of the year going?
I actually still think we finish the year about between 6 and 8% on the S&P 500. We might do a little better. We got to get through this resolution. If oil stays at 120 or higher for the better part of 8 to 10 weeks, very different story. We see inflation go higher. We see the Fed hike interest rates, not cut. That's the black swan of 2026. If that happens, all bets are off. Assuming that doesn't happen, the might of the United States and Israel will overwhelm Iran at some point. I'm surprised Europe's not coming to the rescue to help their own economies. But that aside, it's like the UAE as of late, Saudi Arabia, all getting involved now. The resolution seems like it's not far away. Assuming there's a resolution here in the next 2 to 4 weeks, then at that point we capitulate, we kind of find a bottom, and we start to grind higher, with the real success coming in the fourth quarter of this year. And we kind of find a bottom, understand what's happening, whether this was inflationary or not, get through this and into the summer months when, by the way, seasonality matters. Right now, oil's not super relevant because we're not heating or cooling our homes. We're not driving a lot. We don't start driving and cooling until June. So assuming by June this gets worked out, then we see a nice grind higher to the end of the year.
Awesome. All right, buddy. Thanks. I got to run. All right, Phil Blancato, CEO of Ladenburg Thalmann Asset Management. Thanks as always, Phil. We'll talk soon.
Thank you, buddy.
All right, this is Leo Daprile. This is the Gem Young Wealthcast. I'll be back after this break.
At Gem Young Insurance and Wealth Advisors, we know every financial journey is unique. That's why our team of financial planners, paraplanners, and service professionals work together to provide personalized strategies for a work-optional lifestyle, investments, and risk management. We're here to help you plan for today, protect tomorrow, and enjoy the life you've worked so hard for. Take the first step toward financial confidence. Call Gem Young Insurance and Wealth Advisors at 330-533-6936 to schedule your fit meeting today.
Hey, it's Medicare Jer here from Gem Young Insurance and Wealth Advisors. Medicare can feel confusing, but I'm here to make it simple. With the right Medicare Advantage or supplement plan, you can worry less about unexpected healthcare costs and focus more on enjoying life. Let's make sure you've got the coverage that fits your needs and gives you peace of mind. Call me, Medicare Jer, at Gem Young Insurance and Wealth Advisors today at 330-533-7941 to schedule your appointment, and let's get your plan in place.
By calling this number, you will be speaking to a licensed insurance agent to answer your questions or provide additional information about Medicare Advantage plans, prescription drug plans, or Medicare supplement insurance plans. This is an advertisement for insurance.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo Daprile.
Welcome back to the Gem Young Wealthcast. This is Leo Daprile. Well, that was an interesting conversation with Phil today. What I found interesting is normally when I talk to Phil and Glenn, there's a lot of alignment in where their thinking's about, and these two were pretty different. Still kind of getting to the same conclusions, but how they're approaching the world, the war, the economy, some very different perspectives. And that's always our goal here, is to give you information you're not going to get other places. So if you missed Glenn's podcast, I strongly suggest you download it and listen to it. Check it out anywhere you download your podcast from, or check out the video podcast, which is available on our YouTube channel. But a lot of relevance. So this is a little window that you get from my world when we talk to these guys and we get their different points of view and coming from different perspectives. All of that, I think, just makes you a better informed, so as you're making those decisions on what your work optional lifestyle will look like or is, and how to make adjustments. I think the big picture here is there was a lot of negative noise, but there's some bright spots that you didn't know about. I think looking at portfolios and how things really performed in Q1 versus how the way things were reported really made it look. I think a lot of you are pretty surprised by now, if you haven't got your statements yet, of how uneventful, if you were managing your money the correct way, that's the caveat, and you had the right manager and the right diversification, that you'll find that the first quarter was pretty uneventful for you. You'll have seen that you maybe gave up some mid-quarter gains, but by the way the media reported the ugliness of market returns, you're not part of that. So that's professionalism. That's where we shine. We shine in these turbulent times. And when we have these people like Phil or Glenn, where you're getting a perspective that you don't get other places, that's what makes us different. So, again, download us anywhere you get your podcast. Pretty available to do it. Appreciate you listening today. This is Leo Daprile. This is the Gem Young Wealthcast. Till next time.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
Join me every week where we talk anything and everything about your money. Have a topic you want to hear more about? Email Katie, that's Kayti, at gemyoung.com. You can find us on Apple, Spotify, and the iHeartRadio apps. Until next time, this is Leo Daprile.